Picture this, one stock, $10,000 invested, 30 years of reinvested dividends, monthly income of $6,837. That number is real. I am going to show you exactly where it comes from. But I am also going to be honest with you right now in a way most channels will not. That $6,837 a month is not what you would earn today. Today, that same $10,000 in that same stock pays about $25 a month. I know that gap sounds like a trick. It is not a trick. That gap is the entire point of this video. By the end, you will understand 5 well-known dividend stocks all sitting at or near their lowest price in a year. You will know why each one dropped, what each one pays you today, and how a small amount invested right now can grow into real monthly income over time. And I will also tell you something most channels will not. 4 of these 5 are genuine bargains right now, but one of them has already started bouncing back. I will tell you which one, because I will not sell you a number that is not true. If you are building retirement income or passive income and want to stay ahead of moves like these, hit subscribe. I cover everything that helps protect and grow dividend income, and I post it every single week. And right now, before we go any further, quick question. Are you investing for income you need right now, or income you are building for 10 or 20 years from now? Drop your answer in the comments. There is no wrong answer, but it completely changes which of these 5 stocks I would lean toward for your situation. I read and reply to every comment. The first stock is Main Street Capital, ticker MAIN. Right now, it trades around $52. Its lowest price this year was $48.95. It is sitting just above the floor. Main Street lends money to small American businesses and collects interest on those loans. That interest funds your dividend. It pays monthly, not quarterly, not annually. Every single month, a payment lands in your account. The price dropped because the Federal Reserve has been cutting interest rates. When rates fall, a lender like Main Street earns slightly less on its loans and income can dip. But here is what that actually means. That is a rate problem. It is not a broken business problem. The loans themselves are healthy. Only about 1.2% of them have stopped paying. That is an exceptionally clean loan book. Since going public in 2007, Main Street has never once cut its monthly dividend. Not in the 2008 financial crisis, not during COVID, not now. Last month, the board raised the monthly dividend again by 1.9%. The yield sits near 8%, the highest income on this entire list. And beyond just lending, Main Street sometimes takes equity stakes in the businesses it backs. One Texas investment made in 2006 was sold this past January for a total return of 62.7 times the original investment, including dividends collected along the way. Today, $10,000 in Main Street pays about $67 a month, real income arriving every single month starting immediately. But the highest yield on this list is not where the biggest paycheck comes from over time. The next stock yields barely 1% as wire, and over time it leaves Main Street in the dust. The second stock is Sherwin-Williams, ticker SHW. Yes, the paint company. Right now it trades around $317. Its lowest price this year was about $290. It is near the bottom. And I need you to hold with me here because this is about to sound completely backwards. Sherwin-Williams pays a dividend of just 1%. Next to Main Street's 8%, that looks irrelevant, so why is it on this list? Because of one number. Sherwin-Williams has raised its dividend for 47 consecutive years without missing once, and it grows that dividend by approximately 13% every single year. A 1% dividend that grows 13% annually becomes something completely different over 10 or 20 years. This is the compounding that most beginners never see until it is too late to take full advantage of it. The stock is cheap right now for the same reason home improvement stocks are soft. When people stop moving, they stop painting. But last quarter sales still rose nearly 7% and profit margins actually expanded. The company also just completed $16.5 billion in share buybacks, a company that bets aggressively on itself. Today, $10,000 in Sherwin-Williams pays only about $8 a month. That is not why you own it. You own it for what those rising dividends become in year 10 and year 20. Main Street is income now. Sherwin-Williams is income later. Smart income investors want both kinds working together simultaneously. The third stock is NetEase, ticker NTES. This is the one I need to be straight with you about up front. NetEase is not really at a 52-week low. Its lowest price this year was about $106. Today, it trades around $124. It has already started climbing back. I am telling you that on purpose because I would rather you trust me than sell you a headline. So why include it? Because of what is sitting on its balance sheet. NetEase holds $24.3 billion in cash after all debt is accounted for. That is roughly a third of the entire company's value just in cash. Gaming revenue grew 7% last quarter. The company earned $1.5 billion in a single quarter. Some investors saw the dividend drop last quarter and panicked, but NetEase pays a slice of each quarter's actual profit by design. When profit is higher, you get more. When it is lower, you get less. That is not a cut. That is how the structure works. And there is one risk worth naming clearly. NetEase is a Chinese company that trades in the US through a special legal structure called a VIE that adds a layer of risk American stocks do not carry. This is the higher reward, higher risk name on the list. Today, $10,000 here pays around $20 a month, but that number moves with quarterly profits. The fourth stock is Lowe's, ticker LOW. Lowe's CEO Marvin Ellison said something on the most recent earnings call that stopped me. He called this the most difficult housing market he has seen since the financial crisis. Think about what that means. One of the most experienced executives in retail, running one of the largest home improvement companies in the world, calling this environment the toughest in 4 decades. And then Lowe's raised its dividend anyway. About 60 to 65% of Lowe's sales come from do-it-yourself homeowners. When people stop moving, they stop taking on big renovation projects. So Lowe's feels housing slowdowns harder than most. But last quarter, sales actually rose more than 10%. Online sales jumped over 15%, and Lowe's just acquired 2 companies that opened the door to new home construction, a market it earned almost nothing from before. Lowe's has raised its dividend for more than 60 consecutive years, making it a dividend king. This year, they raised the payment again to $5 per share in the middle of the most difficult housing market in 4 decades. Today, $10,000 in Lowe's pays about $19 a month, and it carries a 60-year habit of raising that payment every single year. The fifth stock is Home Depot, ticker HD. This is the one behind the $6,837 number. Right now, it trades around $312. Earlier this year, it dropped below $290, a 2-year low. Same cause as Lowe's. The housing market is frozen. Fewer moves means fewer big projects. But the business is not broken. Last quarter sales still grew nearly 5%. This is a giant that is simply on sale. Here is the detail that gives me genuine confidence in this one. Home Depot has paid a dividend for 156 consecutive quarters, 39 straight years. But look at what they did last year when forced to make a choice. They had capital to deploy, and they had to decide between buying back their own stock or protecting the dividend. They chose the dividend. They spent $9.2 billion on dividends and $0 on buybacks. They paused buybacks specifically to protect the payment to shareholders. That is one of the strongest signals a company can send. Now the $6,837 number. It is a 30-year projection. You invest $10,000. You reinvest every single dividend received. You let the compounding run for 3 decades. In an optimistic projection with dividend growth continuing at historical rates, that $10,000 grows into a balance generating thousands per month. In a conservative projection accounting for the recent slowdown in dividend growth rate, the number is lower. The real outcome lands somewhere in between. Today, that $10,000 pays about $25 a month. The $6,837 is not today. It is the runway, and the runway is the whole story. Here's the one idea I want you to carry out of this video. You just met 2 kinds of dividend income. Income now, like Main Street paying you every month immediately, and income later, like Sherwin-Williams and Home Depot growing your payment every year for decades. Put them side by side, reinvest the dividends, give it time. That is how a small amount today turns into a real paycheck tomorrow. And remember the principle that ties all 5 together. When a great company goes on sale, the prepared investor does not run. They look closer. A 52-week low is not a warning sign. It is a sale on every single paycheck that stock will ever pay you for the rest of the time you own it. Now the question I want in the comments before you leave, out of these 5, Main Street, Sherwin-Williams, NetEase, Lowe's, and Home Depot, which one are you most interested in right now and why? Drop your pick below. I reply to every single comment. Hit subscribe for weekly breakdowns exactly like this one. Let us build something real.